Oh, hello, how's it going? I'm here to teach you guys what to do in and after a stock market crash. All you have to do is follow 3 simple steps. Step 1 is panic and sell all of your stocks, because stocks are extremely risky. Make sure that you have no stocks and all of your money must be in cash. Step 2 is bury that cash underneath your pillow, because that is the safest place to have your money. Step 3 is pray every night that your house doesn't burn down and that you don't lose all of that cash. That's some simple advice from a simple guy. So basically guys, if you want to succeed in a market crash, do the exact opposite of what that guy just said in the first 20 seconds of this video. However, all jokes aside, let's talk about what you should actually do in a stock market crash and in a stock market correction, because remember, a stock market crash, a bear market and a stock market correction are all different things, and we should prepare our portfolio differently for all of these situations, okay? So let's dig into the video. I hope you guys enjoy it.
I always share the words buy the dip, but what people don't understand is that the dip can still be expensive. So hear me out guys, a stock market correction is a market downturn between 10 to 20%. At the time of making this video, we're pretty much in a market correction with the market down 9.3%. Now what does this mean? It means stocks are 9.3% cheaper than what they were a month ago. So I guess you could call it a mini sale from their higher prices or a discount. So, what should we do in periods of market corrections? Well, what I wanted to point out is that a market correction does not necessarily mean stocks are cheap. Okay, so arguably the best way you can tell if stocks are cheap is by using the market's PE ratio and then comparing it to historical figures. So taking a look at the S&P 500 PE ratio, we can see that it sits at 21.56 at the time of making this video. Now this PE ratio, yes, it looks a lot more decent than what it was a while ago when it was 23, 24, but even 21.56 is still historically high. The average market PE for the US is around 15. So even after this market correction, it does not mean we are at ridiculously cheap levels. It does mean that things are cheaper. So what do we do as investors after a market correction? We keep looking for deals, look for stocks that we believe are going for attractive prices compared to their values. Just because it's a market correction, it does not necessarily mean that stocks are ridiculously cheap and we should spend all our cash on stocks. No, keep your portfolio balanced and continue to hunt for more deals.
So guys, after a stock market correction, you still need your portfolio prepared for all conditions, because you don't know what's going to happen to the stock market over the short term. You know, it could bounce back from what it did from the 10%, 15% correction, or guess what? It could turn into a bear market or a stock market crash. We don't know what's going to happen. That's why we need to have our portfolio prepared for all conditions. I've talked about this before. You need adequate cash in your portfolio. You need to have it well diversified through asset classes and well diversified through countries as well. You should probably be owning gold or silver, one of the two, or maybe bonds. So use some of those strategies to prepare your portfolio for all conditions. Another great strategy is having stocks that pay high dividends. You know, stocks like dividend aristocrats that have paid out dividends for, I think it's 25 consecutive years. So even in market crashes, they continue to pay out dividends. That's a great strategy to use. So guys, after a market correction, you still need your portfolio prepared for all conditions. Now let's talk about what you need to do after a stock market crash, after a bear market.
Now guys and girls, one thing that might happen in these stock market conditions that we are in today is a stock market crash. Now let's define a crash as a downturn that is 20% or more, but with this video let's talk about a proper market crash and a proper bear market. And let's discuss what to do when stocks drop by 40% or more. Just like the 2008 crash where stocks dropped by over 50%, or in the dot-com bubble crash where stocks dropped by around 45%. Right, so we'll just assume the market drops by 40% as an example. Now that means our PE ratio will become 13. So now stocks will be cheaper than the historical prices from back in the day, and 40% cheaper than what they were from buying them today. So what do? We have a couple of options. We can either do what most people do and run for the hills and look for safety. They start buying gold or they start buying long-term government bonds and are happy with, you know, the 2 to 3% returns on investments with a long-term bond. And when you think from a rational perspective, you ask yourself, why in the world would anyone want a return of around 2 to 3% on their investment? And the answer is fear. Fear does funny things to people. People see their stocks go down by 40%. Their net worth has dropped by 40%. So now they become happy with any return on investment, just as long as it's safe and as long as it doesn't drop. So they lock up their money for 10 years at a very low interest rate. Now, obviously, after a market crash, that is one of the dumbest things you can do. Having a large percentage of your portfolio in bonds is not smart. After a market crash, it's the best time to own stocks because they're cheap and you're getting more bang for your buck. Guys, think of it from a business point of view. You're paying less money to buy a business, to buy a stock. Okay, let's say previously you paid $2 million to purchase a business who was producing $100,000 of earnings. Now you're only paying $1.2 million for that $100K of earnings if the market did decrease by 40%.
So after a market crash, it's the perfect time to be buying stocks because that's when they're at their cheapest. Double down on buying stocks. You know, double down on your hours at your job. Try earn extra cash through a side hustle and then put all of that cash towards stocks because they're so cheap and they're going to give you a solid return over time. You know, stocks are the one asset that delivers one of the highest returns along with real estate. I think stocks is around 10% and real estate is around 12%. I think those are the figures over the past 100 years. Correct me if I'm wrong in the comments. But either way, the best time to be buying stocks is after a market crash. You know, ask Warren Buffett and he'll tell you the exact same thing, and that's exactly what he does. He buys a ton of stocks when they are cheap. And Warren Buffett gives this great example of someone called Mr. Market, and he learned this from his mentor, Benjamin Graham. Essentially what Mr. Market is it's a way of thinking about the market. So Mr. Market is a guy who will come and knock on your door every day and offer you prices for the businesses that he is selling and offer to buy businesses that you own already. So some days Mr. Market is pessimistic and will offer extremely low prices, and then other days he's extremely greedy and will offer extremely high prices.
Now with Mr. Market, the obvious thing to do is buy stocks from him when he is feeling pessimistic and selling stocks for ridiculously cheap prices. Unfortunately for most investors, that is not what they do. They do exactly the opposite. As I'm sure most of you guys know, the last market crash was in 2008. Now what do most investors do? They started selling their stocks. Just when Mr. Market starts offering prices that are very cheap, people decide that they want to sell the stocks to him instead of buying it. And even in the years after the crash, when stocks were still ridiculously cheap, you know, 2009, 2010, 2011, and 2012, people still were selling their stocks in droves. The savvy investors like Buffett, they started accumulating a vast amount of stocks in these years when they saw attractive prices. So guys, this is a quote that Buffett teaches us, and it sums things up pretty well. Be fearful when others are greedy, and greedy when others are fearful. Buy low, sell high, it makes logical sense.
I mean, if you think about it from literally any other point of view, you'll do the right thing. So for example, if you go to buy something on Amazon, which I know a lot of my friends do, they get their paycheck and they waste it on junk on Amazon or whatever, they're gonna look for the good deals. They're gonna look for the sales. They're gonna look for things when they're 40% cheaper. Are you gonna buy a house if it's on a 20% discount? Or are you just gonna wait till it's very pricey and then start buying it? Like, do you think I bought this laptop when it's fully priced, or do you think I waited for when it was on sale, when I got a 20%, 30% discount at my local, you know, technology store? Of course, I waited until it was on sale. And, you know, when it comes to stocks, it's weird. People seem to think differently when it comes to their net worth. They see their net worth drop and they think, oh, we got to sell everything and go to safety. And it's so counterintuitive because that's when you really want to be buying stocks, when they are on sale. Everyone would do it right when it comes to, you know, buying other assets like the camera that I bought, the lighting equipment that I bought for YouTube. I waited until it was cheap. But stocks, it's weird. People seem to do it differently. Guys, that's all I had for the video. Stock market crash. In a bear market, that's when you really want to be buying a whole lot of stocks. You want to have most of your portfolio in stocks. And after a stock market correction, you still want to have your portfolio balanced in a bunch of different assets, prepared for all situations. That's me for one video. On Saturday, I'll be going to Australia for a week, so I won't be making a video for 1 week. I'll have a bit of a break, be trying to tan up the skin in the sun. I hope you enjoyed the video, guys. Let's see if we can crack the 40 like mark for this video. It's going to be touch and go. I hope you enjoyed it, and I'll see you in the next one.